it has been estimated that 30% of all the US dollars in circulation have come into circulation in the last 30 months. Now, clearly, this isn't to accommodate economic growth. The economy isn't 30% bigger than it was 30 months ago. There wasn't need for liquidity to manage a buoyant economy. And when you increase the supply of something without increasing its utility, of course, you depreciate the value of the existing stock. There's just no arithmetic way around this. So quantitative easing is the first reason, I think, why investors are concerned about the efficacy of their savings in conventional instruments. But it gets worse, of course. The next is debt and deficits. And this is arithmetic again, too. We have the dubious honor of having crossed $30 trillion in on-balance sheet liabilities. Admittedly, only $22 trillion net of counterfeiting. In other words, the Federal Reserve's balance sheet is $8 trillion. That was printed up. So, but let's use the 30 trillion. It's their number. But more importantly, Robert, and you and I are partly to blame, the net present value of off-balance sheet liabilities, entitlements, Medicare, Medicaid, Social Security, all that stuff. Not some cranky old libertarian, but rather the Congressional Budget Office suggests that the net present value off-balance sheet liabilities of the U.S. government, not state and local governments, just the federal government, is $120 trillion. The worst is negative real interest rates. For the first time, Robert, in your life and mine, the government has made a promise to you that they're going to keep, and I'll explain that promise. If you lend the government money in the U.S. 10-year Treasury, the base security in the world, the most important security in the world, they promise to pay you 2%, and they will, because they can print it. They don't have to earn it, they can print it. They promise to pay you 2% in a currency that, depending on which government agency you read, is losing its purchasing power at 6.5% a year or 7.5% a year. So they solemnly swear to reduce your purchasing power by 4% compounded a year for 10 years. And they will keep that promise. If you give them money now, they will give you back less later. They're guaranteeing this, and they will do it. Less than 0.5% of the value of savings and investment assets in the United States is in precious metals or precious metals securities. The 3-decade mean is between 1.5% and 2%. So if demand was to return to mean, not go crazy like it did in the 70s, Robert, when you learned about the gold trade, if the demand for precious metals returned to mean, demand would triple or quadruple. And there's one more that a lot of people overlook, and that is that after 40 years of really beatific economic conditions, the biggest investors in the world, the pension funds, the endowments, the insurance companies, operate on an asset skew that's roughly 60% equity, 40% debt. And that's worked well for them. The debt has been the stability. The debt has been the stable income. The debt component is a real anchor in a positive sense to the returns that they've promised their beneficiaries 20 or 30 years out. That's all different. I have had periods of time in my life, Robert, when I had no cash. And I've had periods of time in my life when I had a lot of cash. And I was happier and slept better during periods of time when I had a lot of cash. I consider cash to be a soporific, and I like to sleep. From the point of view of a financial plan, cash, liquidity, gives you the means and might give you the courage to take advantage of a circumstance where there was a liquidity shortage. Going back to 2008, late 2008, 2009, were very good investing periods for me because of the liquidity crisis. I maintained a lot of liquidity going into that, and I was able to buy assets because I had the ability, and because I had the ability, I had the courage. The consequence of that is that ever since, I've been running fairly high cash balances, even though the cash guaranteed diminished returns in the near term on my purchasing power. I consider the negative real interest rate that I suffer to be an option premium. Because the cash gives me the tools and the courage to take advantage of any future crisis in confidence or crisis in liquidity. And I actually think that a crisis, while not a certainty, is a probability. So I understand that on my cash holdings, I'm losing 4 or 5% a year in purchasing power. But I think the circumstance might come about in the next 2 or 3 years where the consequence of having that cash is 50, 60, or 100% returns on capital employed by deploying that cash.
I don't save cash. I save gold and silver. And if I ever need the cash, I think gold and silver are liquid.
No, gold and silver are extremely liquid. They're one of the most liquid asset classes in the world. I'm a lender, and I love lending against gold and silver, particularly gold and silver where I control rather than the borrower controlling the collateral. They're enormously liquid. I live in a circumstance that, even given the problems that we face today, is substantially more civilized, more benevolent than the young Vietnamese woman who, the choices that she had in terms of her savings and her business were limited compared to the choices that you and I exhibit. Also, because of the asset classes that I deploy capital into, include what you would call derivatives, what I would call securities, having access to cash to access securities markets without having to sell my gold or silver is convenient for me. Owning physical gold makes me sleep better.
Right.
I'm 69 years of age. I like to sleep, and I consider, like you do, gold and silver to be cash, good cash, but it's volatile cash. The problem breaks down with some in your audience, Robert, because if they own gold and there was a liquidity crisis and the price of gold temporarily fell, they would be less inclined to sell the gold and turn that into an asset, which they could then use to buy another asset. Many people, although they own gold, don't regard it as liquidity. They don't regard it as cash. And if let's say that their average cost in gold is $1,800 and the price falls to $1,500, the price of another asset that they want to buy fell by half, but they feel this strange compulsion not to accept a small loss in cash to take advantage of a bigger opportunity. So in that sense, psychologically, right, for many people, precious metals aren't cash. I don't suffer that same circumstance. For me, it's good cash, it's volatile cash. I, like you, have had some precious metals for a very long time, and it's lovely to see my savings appreciate as opposed to depreciate. Right. People need to take control of their financial present and their financial future, because the big thinkers neither will or can. And so the real why around precious metals, I think, is self-defense.